Hello and a warm welcome to Portfolio Watch. I'm Gugulethu Mfuphi. And our topic today is identifying economic moats. Now, since Mr. Buffett referred to a moat back in 1999, it's become widely accepted, but ask any investor to define the term and you'll find them floundering. Now, it can be described as a competitive advantage, a structural characteristic of a business that differentiates it from its nearest competitors. Yet, it is equally important that management allocate the capital delivered by the moat effectively. Now, there are 4 different sources of moats, but they don't necessarily apply to the same kind of businesses. To further complicate matters, there are qualitative and quantitative moats, which mean that 4 is not necessarily better than 1. But to help us shed some light on this rather complicated topic, I'm joined in studio by Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Henry Biddlecombe, who's an Equity Analyst at Anchor Capital. Gentlemen, great to have you both with us, and thank you so much for giving us your time. Let's go back to this definition and perspective of a moat. We've touched on the fundamental characteristics, but still, I see us still struggling to actually pin it down to how best to identify and understand what a moat is, Andrew.
Yeah, so I think, last week we spoke about quality businesses, and I think a moat kind of lends itself to perhaps helping a company become quality. Just because a company's got an economic moat, and you can think of a moat as, a normal moat around a castle that protects the castle from outside forces. It's exactly the same for a company. If they've got an economic moat, a wide economic moat, it's very difficult for other companies to compete against that business. But just because you've got a moat doesn't necessarily mean that it's actually beneficial to the business or investors. Shareholders need to use that moat appropriately and allocate capital in order to derive returns on capital that are higher than whatever the hurdle rate might be, typically cost of capital. They need to be able to do that. So some companies do have economic moats, but they're unable to actually take advantage of them. And a simple example would be an airline, for instance. Here's a business that's not really that difficult. You need capital to get into it, but you can, and there's licensing and whatnot. But once you've got your airplanes, you can get up and get going. So whilst there's a moat around it from that capital point of view, getting the licensing, etc., airlines, as we know, are not necessarily the most profitable businesses.
Yep.
So here's a company or an industry that's got quite a wide moat. However, that moat's not really used to their advantage, given that they can't translate that moat into economic profits. So it's those 2 points that you need to keep an eye on.
Let's touch on those fundamentals, because we know from a macroeconomic perspective, all of these elements do contribute to the advantages or disadvantages of identifying a moat. Given the cycle that we're in at the moment, where would you say we're seeing particular companies or sectors being the flavor of the month and identified as economic moats? Henry?
So I think if you were to put forward an example, I think PayPal's a great one. It's a share that we've held for some time. And this is a business which boasts over 200 million active users. So it's a very attractive platform for a merchant to join, because you immediately access 200 million consumers. And as a consumer, it's attractive because once you sign up for an account, you can make payments to over 20 million merchants. So that's what you would call a networking moat. And I think it's a great example of a modern business that's developed a very powerful moat.
So given the definition, would you say these are both what, quantitative and qualitative factors that contribute to perhaps PayPal being a significant player here?
I would say that it is, I suppose it's a quantitative moat, but it's also a qualitative moat. Yeah.
I think they probably go hand in hand. So if you're looking at a moat, and to come back to your question, when you talk about the macroeconomic environment that we're in, and does that lend itself to specific moats? I think moats are there through the cycle. So I don't think any specific, by and large, I don't think any, whether you at the early stage or late stage of a business cycle, that's going to really make a massive impact on your moat. If you need license fees to fly an aeroplane, it doesn't matter where you are in the economic cycle. Likewise, if you've got a great brand, which is an example of an intangible asset, which forms part of a moat. Again, your brand is good. Apple's good, whether early stage, late stage of the economic cycle. But then you've got to look at it both from a quantitative and a qualitative point of view. Quantitative, as I mentioned earlier, you can look at the returns on capital and against some benchmark, whatever it might be. Are they able to do that on a sustainable basis through the cycle, so both in an up and down market and also early and late stage of a business cycle? But then you can also just think about it from a qualitative point of view. If you think about networking effects, so you talk about PayPal, Visa, Facebook is quite a topical one given the results last week.
Yep.
So here are companies that have great network effects. And you can just think about that from a qualitative point of view. You might not necessarily have to see it in the fundamentals of the business.
Interesting dynamic, certainly, that we do need to take into account regarding moats, but you also mentioned the capital allocation. And that sounds like a sensitive area because that relies significantly on management. And sometimes they make great decisions, sometimes they don't. How do we measure this or evaluate it from an investor's point of view? Andrew?
Well, I guess capital allocation is a very important skill set that a management needs to have. And that's ultimately what drives positive shareholder returns over the long term. And I guess a good illustrative example of how this translates into investor returns would be the Moat ETF, which Morningstar put together in 2012. And they actually designed that ETF to track the performance of companies that have clearly identifiable moats. And since its inception in 2012, that index has actually outperformed the S&P 500 by about 100 basis points per annum.
So some positive results that we are seeing there, but of course for a lot of investors, some skepticism as to how best to identify it. Is it always best to, of course, speak to individuals like yourselves in the industry? Or what about us as retail investors? How do we go about it?
Yeah, I suppose there's no real black box that's going to spit it out for you. But you mentioned earlier 4 types of economic moats. So you can just, from that sort of framework, you can think about it. So we've touched on networking effects. That might be one. Switching costs is another one. If it's difficult you can think of Microsoft. I know that we might talk about just now, but it's quite difficult to switch away from Microsoft to other operating systems, given that Microsoft is widely used everywhere. That would also lend itself to a networking effect. You've then also got your intangibles, which we've touched on. That could be brand, intellectual property, and the like. And then the last one is your cost advantage or economies of scale. You might have some sort of cost advantage, being able to be in the right place to produce a good at a lower cost than what your competitors can do, and hence you're going to derive higher returns on capital. Likewise, economies of scale. If you're a bigger business, you might have that economy of scale that allows you to drive your returns on capital. Yep. So if you think about it just from those 4 points of view, you can tick or put a line through each one as you think about a business from a qualitative point of view to try and assess. Then that should you should be able to then see that in the fundamentals in terms of their return on capital being sustainably high.
Perfect. Well, we've touched on the fundamentals and the outline with regard to what influences investing in moats, but let's get into some of those pillars that were identified just a moment ago by Andrew to really understand how networking and switching costs influence particular stocks. Let's take a look at our equities feature. Well, let's pick up on the first one. We've mentioned some of these companies already. Microsoft is one that you've touched on. Facebook, we know, is an all-time favorite, except given what the share price has done following the release of its results. And PayPal as well. For the novice investor who's not really sure as to some of the implementations and concerns here about network and switching costs, tell us how they might actually have played an influence in these individual stocks and how this is playing out now regarding their share price performance, allocation of capital, and of course investor returns. Let's start with you, Henry.
So I think you need to go back to how you determine the intrinsic value of a share, and really it's the present value of its future cash flows. So obviously the more defensive those cash flows are, the more valuable they'll be. So there's a great example overseas actually. It's a company called Zimmer Biomet, and what they do is they produce medical devices. In fact, they produce joint replacements. Oh. Now the way it works is when a doctor starts doing joint replacements, he'll train on a certain system, and that training is expensive and it takes around a year. But once that doctor's trained on that particular system, he stays on that system for life. So it's a long selling cycle, but once you've pinned him down as a customer, he's a customer for life. So what that means is the profits that company generates are extremely defensive, and that makes the business valuable. Mm-hmm.
If we do take a look, though, at these particular stocks, and of course Microsoft is also one that you touched on, Andrew, from your perspective. Perhaps let's also throw in Facebook there. It's been one that we've covered on the show previously, and of course has similar effects to the market dynamics here.
Yeah, if I can just touch on, I think, quickly what Henry said about your medical devices business, and we've spoken about Medtronic. Here's another one. When a company has switching costs as a moat or an economic moat, it comes about through switching costs, you've got to ensure that that company doesn't abuse its market power. It's got to keep reinvesting, improving its product, because it's very easy. Once you've got a product that's difficult to switch away from, the company could sit on its laurels and just let that product continue to be used without innovating, without making it or improving on it, etc. And I think Microsoft, you touched on it. Microsoft's a great company or an example of a company that does this. when you think of how many Windows, I don't even know what Windows we're on now, Windows number, I don't know, 10 or whatever it might be. But they keep, investing back into that product, not just saying, well, we've done it, it's difficult to switch away from it, so, so off you go. So I think that's an important consideration when to think about, switching costs. And these medical devices, whether it's, Medtronic or the like, they tend to be doing that. Facebook, it's obviously a very topical one, but a network effect is, the more users that join, obviously the better it is for the current users as well as the new users, and as well as the company, and that's what Facebook's obviously built around. That's selling ads to whoever their clients are.
Another internet, indeed.
But if you think about switching costs, like network effects, another great example is a restaurant. Now this one might actually work against it, because the more users, the quality might go down, the service might go down. So networking effects up to a certain point might be great for a restaurant, because you want word of mouth, but past that point, it might actually become negative. So there's a lot of things you've got to think about from a networking point of view as well.
And different depending on the various sectors. Absolutely. Honeywell was also one of those that came up, and I understand it's a stock that you're quite keen on here, Henry.
It was actually Andrew's stock.
Andrew's stock, okay. But any terms of agreement, or do you disagree with Honeywell? Do you view Honeywell maybe as a great investment?
I'm actually not familiar with the business.
Sure.
So Honeywell, Honeywell's...
So educate us here, Andrew.
Yeah, Honeywell's the global Bidvest. If you think about, he has a conglomerate industrial company that does literally everything and anything. From a capital allocation point of view, I think they're saving grace, and I don't want to be rude to General Electric, but there was going to be a merger in the early 2000s of General Electric and Honeywell. They, with the benefit of hindsight now, they missed that. But
and we know how GE's been in the past with capital allocation, right?
Exactly, absolutely. So if you think about switching costs, one of the products that Honeywell makes, are aircraft products, engines, avionics, auxiliary power systems, that once you've got those in the aircraft, it's very difficult for the airline to move away from that. They've got to, that's an original equipment manufacturer, they've got to go back for parts, servicing, etc. So there's switching costs, another good example of a moat due to switching costs.
We've touched on quite a few tech stocks, which have certainly been the flavor of the month for many investors, despite some of the mixed results that we've seen. And Netflix is also one of those. I understand another example that also comes in with regard to the intangibles that we need to be mindful of with regard to moats. Tell us a little bit more about this.
Can I pass this one to
Henry?
Sure, let's pass it to you.
So I think Netflix is actually one of the more interesting ones out there at the moment, because this is an interesting case study in how much is a moat worth. Because here you've got a management team which is investing billions of dollars a year. At the current rates, I think it's $13 billion a year into unique content to create a competitive moat for themselves. But they're only making $1 billion in net profit. So they're betting on the fact that those investments are going to pay off over time. But the story hasn't played out yet. So I'm unconvinced around the economics of that business at this point. But it's going to be a really interesting one to watch.
Are there any opportunities to watch it? Because I know they're disappointed with the subscriber numbers, and of course that also saw a negative impact on its share price. Some might actually think a great opportunity to get in, given that the share price taken a bit of a dip.
Yeah, look, I think the problem there is you've got a business that's generating a negative free cash flow. And that concerns me. I think the market's become obsessed with subscriber growth, and the stock's almost trading on sentiment. But in terms of, it's actually very difficult to establish a fundamental value for that business. So it's not a stock that I hold, but obviously that's been the wrong call, because it's delivered 95% over the last year. So sometimes it's not about fundamentals, sometimes it's about momentum.
Sure. Andrew, your views on Netflix?
Yeah, so I think, he has a business that's priced for perfection. It ran up, it's done hell of well over the last, 5-8 years, if you go back to 2010. But as you see, these companies that are priced for perfection, the minute there's a slight miss, so I think they had 1 million less new subscribers, and you see what happened. And it's the same thing with Facebook. So you might now sit back and say, wow, are these businesses broken? But look what they've actually done over the past 2-3 years. So despite what Facebook came off, when was it, last week Thursday, 20%. If you go and look what it's done since listing, when was it, about 2013, 2014, I forget exactly, at $20 up to $200, there's a 10-bagger right there. It pulls back 20%, so now you're sitting on an 8-bagger. It's still a fantastic investment. And if you can buy a business today on a PE of 24 times in the US that's growing at mid 30 digits, at mid 30%, that I think is a no-brainer still.
Sure. Interesting dynamics and so much to consider when it comes to identifying moats and, of course, how best to invest in them. But do stay with us, as you can also email your questions and thoughts to portfoliowatch@abn360.com and join the conversation on social media at CNBC Africa, #PortfolioWatch. We'll be back unpacking more investment dynamics and how best to identify a moat after the break. Welcome back to Portfolio Watch. We are still in conversation talking about moats and, of course, how best to identify them. But we obviously want to hear your views. So send us an email, portfoliowatch@abn360.com, or interact on social media using the account name @CNBC Africa, #PortfolioWatch. I'm still joined by my guest, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, as well as Henry Biddlecombe, Equities Analyst at Anchor Capital. Well, we've touched on some of the stocks to consider and the various dynamics with regard to identifying moats in their 4 different pillars. But let's also talk about the S&P Global. I understand naturally this is an index and many of us don't necessarily pay attention to it as one particular investment model, but there have been some interesting trends there, right?
Yeah. So you talk about the S&P index, that's just one part of their business. It's the most profitable, so when you look from a margin point of view, we know, I think the most widely known index is the S&P 500, you know, so there's license fees when asset managers want to use it as a benchmark, etc. But there's also, from a moat point of view, there's an intangible asset moat that's in place here. If you think from trust, you know, what do S&P also do? They're credit, as we know in South Africa, they're a credit ratings agency, and they've built up this experience and the trust in delivering these ratings agencies. So if Henry and I had to go and put out the Henry and Andrew rating, not too many people are going to take too much notice of it. It's not exactly, you know, hugely intellectually intensive. We can quite easily go and look at a company's balance sheets and form our own sort of, you know, credit rating. But the fact that S&P Global have the trust they've built up, the name and the brand in that regard is incredibly powerful. Mm-hmm. And even then, if you think back to 2008 and 2009, people are very quickly going to say, well, these guys, you know, didn't know what they're doing, because here you had, you know, Lehman Brothers with credit ratings of whatever they were, A plus or double A's or whatever they were back then, and they went bankrupt the next day. But what resulted after that is that compliance costs have literally tripled since then. You know, so now the barriers to entry to get into that space because of that have actually increased. Yeah. So you've got a barriers to entry plus the intangible assets. You know, from a moat, S&P Global is a great example. Could we see things change? I mean, they do have some competitors in the market. Are there any dynamics that they might be working on in order to increase the competitive advantage? Yeah, so, you know, I don't think there's exactly a massive competitive advantage once you're in that space. You know, as I said, from an intellectual, you know, intensive point of view, the intellectual property is not, you know, it's not like a pharmaceutical business that's a top secret. But there are essentially only 2 other, you know, global competitors that they've got, in Moody's and Fitch. Mm-hmm. You know, so there's only essentially 3 of them. So you can almost think of it as a, you know, oligopoly. Yeah, so it's not, you're not having a huge amount of competition coming in from the outside. Makes sense. If we touch on another company, management accounting or management consultancy firm, Accenture, if I'm not mistaken, not listed, or unless I'm, you know, quoting the incorrect firm here, but how do we get involved in this one and identify it as a moat? Accenture is listed. It's listed in the US. It's been listed for a long time. Okay. So here's a, you know, now these guys build up relationships with their clients, which again is an intangible, you know, asset, which forms part of their moats. But they're in a fantastic position in that, you know, they work with some of the most progressive multinational businesses that are out there around the world. You know, so if you want to be at the cutting edge of technology and know what's going on in different industries, Accenture are right in the sweet spot, given who their clients are. And they build up, you know, relationships with their clients that are long lasting. So I think, you know, of their top 100 clients, 99 of them have been with Accenture for 5 years, and I think 97 of them have been with them for 10 years. So once you're into those businesses and you're consulting and, you know, and the like, you're there to stay, and you're also at the leading edge. And funny enough, when you also think, one last point on Accenture, when you think about technology and how it's disrupting and displacing humans in the workplace, you know, Accenture, it's actually happening on the opposite side. People, or their workforce, is actually expanding as technology improves, because companies want to consult with them to find out, you know, what the next big thing is, etc. So they're having to hire more and more people.
Sure.
So it's actually working. There's like a opposite dynamic from a technology point of view there. But yeah, another good example.
Interesting dynamics there, certainly. And of course, maybe an opportunity again for South African investors to look at that offshore opportunity. Speaking of offshore, not only another fantastic export from South Africa, but also a leader when it comes to the innovation space, Tesla. And when we think of Tesla, we think of Elon Musk and, of course, some of the interesting innovations that they completely are working on. What's your investment view on this particular moat, especially from a barriers to entry point of view?
Well, as Andrew said before, I think this is a stock that's priced for perfection. And it has a very interesting barrier to entry in that they have somewhat of a first mover advantage, but they've also invested a huge amount of capital into building a gigafactory, into building a mass production facility that produces a different type of car, a type of car that the other car manufacturers aren't producing currently. So it would be very difficult to now go and invest in a business that was going to compete with Tesla, and you'd also need to raise a huge amount of capital to do so. But I think with regard to all of these tech shares, there's also a really interesting discussion around how we think about economic moats. Because I think at present we're seeing a frequency and a level of disruption that the markets probably haven't witnessed before. And it has a lot to do with the optionality that exists in the massive free cash flows that a lot of the FANG stocks are generating. And in fact, that becomes a little bit of a moat itself for the likes of Amazon, Alphabet, Facebook, because they have so much money available to them that when they decide to enter an industry, they can buy the biggest and the best, and they can invest the most. So you start to worry about the durability of the competitive moats that participants in those various markets have currently. And you also start to try and ascribe a value to the optionality in those businesses that isn't necessarily reflected in just placing a multiple on their earnings.
Makes sense. Yeah. Makes sense, and of course a lot of elements to consider there. Just very briefly, as we do wrap up today's conversation, what we've certainly seen is this rising trend of moats being more prominent within the tech space, and of course innovation and disruption, and globally so. But we haven't touched on any South African stocks that might have some of these characteristics. Are there any that are listed on the JSE that could be described as moats? Andrew?
Yeah, absolutely. So I know we've focused on the offshore, but there will, if you think about some of the food producers, there's some great brands when you just think, so we're not talking on a global scale, but just locally, if you think of Tiger Brands and, some of the food products that they produce, there's fantastic brands that, Pick and Pay or Spark coming in with their no-name brands are going to battle to compete against them. So there's an example. There's also, we've got multinational businesses that are listed here, British American Tobaccos and the like, that will also have a moat in place. Henry just touched on it as well, and I think it's also an important point that moats are also never stable. So they're always, they're either increasing or decreasing. So if you think about a Coca-Cola, that might be an example of a good company or a good brand and moat that's fairly stable over time. But typically moats are generally moving, either getting wider or narrower. So you've also got to just pay attention to that.
Identifying the various trends as they come and go. A big thank you to the both of you for joining us today and giving us some perspective on moats. A big thanks to my guests, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Henry Biddlecombe, Equities Analyst at Anchor Capital. Of course, we want to hear from you, so get in touch with the details listed on screen. Tweet us at CNBC Africa using the hashtag PortfolioWatch, and your emails to portfoliowatch@abn360.com. Until next time, do be sure to join us again on Portfolio Watch.